Right now, the silver market is facing one of the most extraordinary moments in decades. Margin hikes are hitting COMEX contracts, China is locking down exports, and registered inventory is collapsing. In this video, we're going to break down what's really happening behind the headlines, why paper and physical silver are diverging, and how institutional players are quietly reshaping the market. This is not just market noise. It's a structural shift that affects global supply, industrial demand, and the way silver is priced worldwide. Stay with me as we unpack the real story behind the silver market today. CME margin hikes and market stress. Friday night, the CME clearing issued advisory 25393, signaling significant margin hikes across nearly every precious metals contract. Silver contracts jumped $3,000 per contract to $25,000. Gold went up $2,000 per contract to $22,000, while platinum and palladium rose by 23% and 20%, respectively. This is the second margin hike in just 17 days, echoing historical patterns we've seen before. If we look back to 1980, the Hunt brothers faced financial ruin after a similar playbook, and in 2011, a series of 5 margin hikes triggered a nearly 30% market crash. But there's a key difference this time. The physical supply is tightening even as the paper market reacts. In just 72 hours, China is implementing an export licensing system for silver. Only state-approved firms can ship refined silver out of the country. Keep in mind, China controls 60 to 70% of global refined silver supply. The result? While COMEX prices crashed from 83.75 to 75.15 in just 70 minutes, Shanghai silver continued trading at 85. Physical buyers paid premiums while paper contracts were liquidated. This is not capitulation, it's market transfer, with real silver moving into the hands of those who need it for industry and production. Understanding the physical versus paper silver market. To understand what's happening, you need to separate two markets: paper silver and physical silver. Paper silver is speculative. Margin hikes can force leverage positions to liquidate, and prices can swing dramatically. Physical silver, however, is real supply. The ounces that factories, solar panel producers, and manufacturers actually need. You can raise margin requirements and shake out speculators, but you cannot margin hike a solar panel factory that relies on silver to operate. Since 2021, the silver market has experienced a cumulative deficit of 820 million ounces, equivalent to an entire year of global mine production. COMEX registered inventory is down 70% since 2020, and this is the 5th consecutive year of structural shortage. What this means is simple. The paper market can be manipulated, but the physical market cannot be created on demand. Industrial demand is insatiable, and supply cannot respond fast enough. The institutional flip. Meanwhile, retail investors are chasing the wrong story. Headlines suggested that 8 megabanks were trapped in silver shorts as prices hit 80. But after 72 hours of verification, the evidence shows otherwise. No JP Morgan filings indicate a crisis. No December bank failures occurred according to the FDIC. The supposed emergency Fed repo is based on a single low-accuracy source. What really happened is extraordinary. According to CFTC bank participation data from December 2nd, U.S. banks flipped net long in silver futures for the first time in recorded history. JP Morgan alone reportedly shifted from 200 million ounces short to 750 million ounces long in physical silver. This is the largest position flip in silver market history over just 30 days. The banks are no longer suppressing the market. They are positioning themselves ahead of an anticipated supply crunch. While the mainstream media debates whether silver is overvalued, institutions are quietly accumulating the metal that actually exists. Supply constraints and industrial demand. The structural shortage is compounded by the way silver is produced. Approximately 70% of silver comes as a byproduct from copper, lead, zinc, and gold mining. This means that even if prices double, a copper miner will not dramatically increase silver output. Primary silver mines make up only 28% of supply, and it takes 10 to 15 years from discovery to production. Meanwhile, industrial demand is booming. Today, 59% of silver consumption is industrial, compared to 35% during the 1980 Hunt brothers squeeze. Solar panels alone consume 232 million ounces this year. Electric vehicles require double the silver of combustion engines. AI data centers need silver for every connection in every server. Add in China's export licensing system, shrinking COMEX inventory, and the highest lease rates since 1980, and you have a market that is structurally short, industrially essential, and extremely illiquid. Two markets, one reckoning. What we're watching now is the discovery of which market price is accurate. Paper silver trades on futures, speculation, and margin rules. Physical silver trades on real-world need and industrial application. When futures prices drop due to margin hikes, paper traders are shaken out, but physical demand continues, absorbing every ounce of supply. This is why premiums widen during crashes. The real buyers are paying more, and the paper market cannot deliver physical ounces fast enough. This is not a temporary spike or a retail-driven frenzy. This is the market discovering its true scarcity, and it is happening right now. Key takeaways for viewers. Here sucks what you need to understand. Margin hikes are a tool to control leveraged positions. They cannot create silver where none exists. China's export control means the majority of the global refined supply is now under state management. Institutions are flipping long, positioning for supply shortages before retail investors even realize it. Physical silver is scarce, and industrial demand is inelastic. Solar panels, EVs, and data centers cannot pause production. Two markets exist now. Paper silver is volatile and speculative. Physical silver is being hoarded and allocated. This is not panic. It's the market discovering reality. The next time you see silver swinging wildly in price, remember, the underlying story is supply and demand, not headlines or rumors. In conclusion, what we are witnessing is a historic moment in silver markets. Margin hikes are shaking out speculators, but physical demand is absorbing every ounce. China's export control, COMEX inventory collapse, and industrial growth are creating structural shortages. Meanwhile, institutions are quietly building positions in physical silver, anticipating the next stage of this global shift. The narrative of collapse and trapped banks is a distraction. The real story is the flip to net long positions, the structural shortage, and the divergence between paper and physical markets. If you want to understand silver markets, watch the movements of physical silver, industrial demand, and institutional positioning. That is where the truth is revealed. Retail noise, margin hikes, and daily price swings are secondary to the larger trend. Real silver is becoming scarce, and the market is adjusting to that reality. This is not speculation. This is supply and demand. This is the silver market today.